In 1929, Joseph Kennedy made three moves before the crash: cash, gold, volatility. When the market collapsed 89%, he walked away with $50 million while the country fell apart. In 1987, Paul Tudor Jones made the same three moves: cash, gold, volatility. On Black Monday, when the Dow dropped 22%, he made $100 million in a single day. In 2008, Michael Burry and John Paulson repeated the same three moves. The system imploded and they made billions. And now in 2025, the smartest investors alive are doing those same three things again. Buffett, Dalio, major hedge funds. Cash, gold, volatility, not two moves, not five. The same three that show up right before every major market collapse of the last century. This is not a theory. This is a mechanical pattern triggered by the same sequence every time. Extreme valuations, excessive leverage, a sudden trigger, forced liquidation, panic. And before that chain reaction begins, the insiders who understand the cycle always move first, while the rest of the world stays fully exposed without realizing the danger ahead. So let me show you exactly why these three moves work. First, cash protects you from forced selling. Second, gold protects you from the currency reaction after the crash. Third, volatility gives you the chance to profit when markets violently unwind. These three together form a cycle of defense and offense. And the reason they repeat is because crashes always follow the same physics. When markets stretch too far, buyers vanish. Leverage flips from a weapon to a trap. Margin calls spread through the system. Then the liquidation wave begins. People do not sell because they want to. They sell because they must. If you understand that sequence, you understand why cash is always the first trade. Kennedy saw it in 1929. He saw everyone borrowing on margin. He saw prices rising without real buyers underneath. He understood that the smallest drop would trigger a chain of margin calls. So he quietly sold his positions over months, preserving cash, while the entire country believed the boom would last forever. When the crash hit, he was already safe. The public never saw the exit because smart money exits slowly. Multiple small steps, not one dramatic move. That is what is happening now across major institutions. Buffett has been doing the same thing. Raising cash quarter after quarter, cutting positions in companies he once called his favorites. Not because he hates them, but because valuations have risen far beyond fundamentals. He now sits on a historic amount of cash. Not a coincidence, a preparation. Ray Dalio has warned openly about unsustainable debt, rising geopolitical risk, and the need for neutral stores of value. Firms across Wall Street are raising liquidity not to chase new highs, but to protect themselves from what happens when leverage unwinds. It is the same structure every time, the same pattern unfolding. Gold becomes the second move for a simple reason. When crashes happen, central banks respond by creating money. They lower rates, they inject liquidity, they expand balance sheets. This pushes down the value of the currency itself. After 1929, the dollar was devalued. After 1987, the Federal Reserve flooded markets with liquidity. After 2008, quantitative easing printed trillions. After 2020, the same occurred. And in each of those moments, gold protected purchasing power. It held value while fiat weakened. That is why central banks are buying record amounts of gold right now. They are preparing for the currency reaction that follows. Gold is not about getting rich. It is about not getting poor when the system shakes. That is why investors like Dalio and global reserve banks hold it as insurance. And when everyone else is losing value, gold rises because it has no counterparty risk. It is not a promise. It is not a loan. It is not a claim. It is a physical store of value. That is why gold buying is accelerating at the same moment insiders are raising cash. First, protect capital. Then protect purchasing power. Then position for what comes next. Which brings us to the third move. Volatility positioning is where the opportunity lies. Kennedy shorted stocks and profited from the panic. Paul Tudor Jones bought put options and made hundreds of millions in hours. Burry and Paulson bought credit protection and turned it into billions when the financial system cracked. Volatility is the only thing that rises when everything else falls. When markets panic, volatility does not creep higher. It explodes. A small position can multiply many times over. This is why sophisticated funds are quietly buying protection now. VIX calls, put options, credit default swaps. They are positioning before the trigger becomes visible to the public. Most people do not realize that crashes start long before headlines appear. They begin internally as credit stress, liquidity thinning, and silent withdrawals by large investors. By the time the news reports trouble, insiders have already repositioned. The public always sees the crash last. That is why these three moves are made early, 12 to 18 months before the impact. That window matches what happened in 1929. It matches 1987. It matches 2008. And based on behavior from major funds, it is happening again. When their actions align, it means risk has reached levels where the probability of a major decline rises sharply. You can already see the cracks. Corporate insiders selling stock at levels reminiscent of past peaks. Commercial real estate under pressure from refinancing at higher rates, banks quietly reducing lending exposure, volatility remaining unnaturally low despite rising geopolitical tension. These are not random signals. They are structural warnings. And the smartest investors do not wait for the final trigger. They act when conditions are stretched and probabilities shift. They position before the crowds notice. They prepare in silence. That is why the cash piles are rising. That is why gold accumulation is accelerating. That is why vol hedges are appearing early again. The mechanical nature of crashes explains the consistency. It starts with extreme valuations. When valuations stretch too far, the future returns shrink. Then leverage rises as investors borrow more to chase momentum. Then a small shock hits. It could be credit stress. It could be earnings. It could be geopolitical risk. The trigger itself is irrelevant. What matters is the structure behind it. Once selling begins, leveraged investors face calls. They sell to meet them. Their selling pressures others. That pressure compounds until it becomes a liquidation wave. This is why markets fall so fast. Crashes are not emotional. They are mechanical. In every cycle, the public assumes this time will be different. They believe new technology or new monetary policy will remove risk. Yet each cycle ends the same way because human behavior and leverage are constant. That is why the pattern of the three moves repeats. Cash to avoid being forced into selling. The only question is whether you prepare early or react late. Late reactions are always emotional and always costly. An overlooked part of the pattern is the opportunity that comes afterward. Kennedy used the aftermath of 1929 to buy distressed assets at fire sale prices. Jones used gains to expand his fund. Paulson used the 2008 profits to purchase undervalued assets across multiple sectors. Volatility profits create liquidity at the exact moment the world is selling everything. That is the fourth move that no one talks about. Buying when confidence is gone. Buying when everyone else is running away. But none of that is possible if you enter the crash overexposed. That is why professionals reduce positions early. They would rather miss the final stretch of gains than absorb the full damage of the collapse. Missing 5% upside is nothing. The math is unforgiving. Recovering from small opportunity cost is easy. That is why insiders always move early. Capital protection always comes first. That is the discipline ordinary investors struggle to practice. Most investors mistake activity for intelligence. They chase narratives. They chase predictions. They chase the next big thing. Cash answers that. Gold answers that. Volatility answers that. They give you time. They give you clarity. They give you options. And when the crash hits and liquidity disappears, those who prepared quietly will be able to act while others freeze. That is the difference between surviving and compounding. You're not trying to predict the exact day or the exact trigger. That is impossible. You're preparing for the sequence. Trigger, liquidation, panic. You do not need insider data. You do not need complex models. You need to understand human behavior under leverage. When people borrow heavily, they lose control of their choices. When prices fall, they have no freedom. They must sell. That is what crashes are built on. A chain of forced selling. So where are we now? We are in the late phase of the build-up. The signals are flashing the same way they did before every major collapse. High valuations, record cash reserves at major institutions, and rising demand for volatility hedging. These are not opinions. They are behaviors. Their actions tell the story. Their risk adjustments reveal the truth. They are preparing for impact long before the headlines. The question is simple. Will you prepare or react? Preparation means reducing exposure, raising cash, adding gold, buying limited risk protection. Reacting means panicking when prices fall and selling at the worst moment. The market rewards preparation and punishes reaction. If the pattern repeats, you will see forced selling spread quickly. You will see volatility explode. You will see liquidity vanish. Headlines will turn from optimism to fear in days. But the signs were obvious. The smart money moved early. The public moved late. If you understand the pattern, you do not fear it. You use it. Crashes are not endings. They are transfers of wealth. From the leverage to the liquid, from the emotional to the disciplined, you choose which side you stand on. Cash preserves capital. Gold preserves purchasing power. Volatility creates opportunity. Together they turn chaos into clarity. And the cycle that destroys many becomes the cycle that transforms a few. The same pattern across a century. The same three moves repeated again and again by those who refuse to be caught by surprise. The moves have already begun. The insiders are already positioned. The clock is already ticking, whether you prepare now or regret later. And the ones who saw it come